On several occasions, I've asked people who had some questions to post them into the comments of the videos we make and that we would address them in future videos. And so we've selected a few and we're going to talk about them and then take your fresh questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we take your questions. And I have, on many occasions, said if you had questions that you wanted me to address in future videos, to throw those into the comment section of earlier videos that we have made. And we have selected a few, and we're going to get to those. One thing I wanted to just mention right before we got to that, for anybody who hasn't been paying attention to the news that we're getting today, it seems that Intel's investment from first the U.S. government and then from NVIDIA aren't sufficient, because Bloomberg, at least, is reporting now that apparently the company has reached out to Apple and asked whether they might make an investment of several $billions into the company. Stock is trading significantly higher on that. I find that rather interesting because the way I read it, it suggests that the company feels that the earlier investments are insufficient to meet their needs to maintain their operations. So I'm not sure that I'm quite as optimistic about its impact for the stock, besides which, if they do make an investment, that's going to dilute other investors. I don't know how that would be structured. Would it be structured as debt, as convertible debt, some sort of a PIPE? Who knows? PIPE, by the way, just an acronym, just stands for a private investment in a publicly traded equity. In any case, it's worth just keeping an eye on it for those of you who hold Intel. I think it's kind of interesting. Okay, so that was just breaking right before we came on, so I figured I would give that a mention. So let's go to some of the questions that we got. We're going to talk about three of them, and the first one that came up was from FinWest. As for a suggested topic, one area I'd like to understand better is trade sizing. For example, suppose I sell naked puts ahead of earnings in two different stocks. Assume the dollar risk is the same, should I get assigned, but let's say one is NVIDIA and the other is Coke. The volatility profiles are radically different. How should I adjust position size to reflect that risk? Excellent question. I want to just point out that there's one other thing that folks should probably think about in addition to volatility and trade sizing in terms of the notional amount. That's the amount of dollars that are committed, and that's correlation. But let's get to that after we address the volatility part first. So first of all, when it comes to risk assessment and position sizing, generally speaking, volatility of the underlying asset is in finance generally the sort of the most broadly used way to measure risk. It is used by exchanges. So I'll give you an example. In commodity pricing, we'll just pull up the description for the WTI crude futures contract. So this is now CME. It's part of the NYMAX, where I was once a member. And if you look in the lower right-hand corner over here, you're going to see the margin requirements. There's a speculator margin. There's a hedger margin. And if you happen to trade these instruments, then you will know that the margin requirements for these contracts change over time. And what changes it is how volatile the asset becomes, how volatile those futures become. If volatility increases sharply, the exchanges will increase the margin requirement. And that's associated with how much they think that the price can move on any given day. For banks, it is very much the same thing. If you are a member of the OCC, they use a form of a value at risk methodology to establish what the bank must post as margin for their position. So they basically take a look at all of the positions. They assess what the 95% confidence interval is. So in other words, they expect your P&L is going to move by some amount 95% of the time. And then they use something called an excess shortfall calculation. And what that is it basically says, okay, 95% of the time we think you're going to live inside this band. What happens the other 5%? right? So the 2.5% to the upside and the 2.5% to the downside. Different entities might choose different confidence intervals to do this. And then they calculate the average, the weighted average value of those tail events, and that essentially becomes your margin requirement, right? So they assume that you're going to live within this band. They come up with an average value if you fall outside of that band, and then they say that's how much you have to post, which intuitively makes some sense. Okay, so moving from there to individual position sizing, portfolio managers at a mutual fund or a 40 Act fund or an ETF, they have to live within registered investment company rules that have portfolio concentration requirements. The portfolio concentration requirements for a fund, and I realize it's kind of long-winded, but it just sort of gives us some context on how we think about these things. Usually we just sort of refer to the 25-5-50 rule, which is that you're not going to have more than 25% of a portfolio in any one asset, and you're not going to have more than 50% of the portfolio in any group of portfolio constituents that is more than 5%. So one way you can think about that is that if I have $1 million in a portfolio, I can't have more than 250,000 or more in any one stock. And I can't have 500,000 or more in groups of stocks, each of which represents more than $50,000, right? So 5% of $1 million, 50,000, can't have more than 50%. And the thing is about a rule like that, in terms of portfolio management and risk management that FinWest is hitting on here, is that that's only half the story, right? Because 5% of one stock may be very, very different than 5% of another. The examples that FinWest is providing are NVIDIA and Coca-Cola. And I would also add that correlation matters. In other words, if you have $50,000 in NVIDIA, 50,000 in Broadcom, well, that's going to be a little bit different than, say, 50,000 in NVIDIA and 50,000 in a completely unrelated business, right? So let's talk about the volatility component first. And the way I would think about that is think about your portfolio construction, how much risk exposure you're willing to commit to any name, and then weight that by the volatility of the underlying asset. You were using NVIDIA and Coke as examples. Let's take a look. So the 30-day realized volatility, and did I leave this? I do. Okay, so I'm going to just click this off. Oops, I have a laptop here. It's blocking my screen. Okay. Actually, NVIDIA's volatility has not been that high lately, but this gives us a sense, right? This is a one-year look back. We can see how high 30-day volatility has been. Let's just use the average. So the mean volatility for NVIDIA is 48. And now we'll do the same exercise and take a look at Coke, which is going to almost certainly be a very, very different number. All right. And maybe 30 days isn't, the right window in terms of what your realized volatility calculation is going to be, because it tends to move up and down a little bit more, but it's a good place to start. So as we look at this, we can see that the mean volatility for Coke is 17, right? So 48 versus 17. Coke is way less volatile. In fact, it has only 35% of the volatility that NVIDIA does. So if you are going to use what's called a risk parity approach, a risk parity approach balances the constituents of a portfolio based on essentially the dollar risk or percentage of value risk that each of those constituents is likely to have on the portfolio. So if you were trying to have an equal amount of risk in each of the constituents, and I'm not suggesting this is what you should do because that's a separate question, but this helps us think about how to weight these things, then in this case, you could allocate considerably more to Coca-Cola than you could to NVIDIA. Now, if you have two relatively high volatility assets, but they are anti-correlated, then you can also increase the respective allocations to these, because their impact on the portfolio overall are going to have a much lower impact, right? So if I have something that moves at about 60% of the rate of some risk asset, but in the opposite direction, that meaningfully mutes the volatility of those two as constituents of the portfolio, and I can downsize it. So what I would do is, first of all, think about how much risk you want to allocate to a given asset, what percentage of the portfolio, and then look at the volatility assumption to assess what that's going to work out to. And obviously, this is a pretty simple calculation. You can just take the volatility number and use that as a weight, if you will, as a part of that exercise. So that's effectively how you do it. So you could, in other words, in this instance, let's just say the only thing we had was the 30-day, the average 30-day volatility, and we were saying, okay, how do I weight these two? In theory, you could deploy notionally almost 3 times to Coca-Cola what you could to NVIDIA, right? So I hope that makes some sense. Now, again, part of this also gets down to the fact that most people are managing portfolios, and that's not necessarily how they feel. So, for example, at Ivory Capital, our mandate essentially allowed us to risk as much as 7.5% of the fund's assets in any bet, if you will. However you happen to think of a bet, that could be a single stock, it could be a sector bet or whatever, and at least 50 basis points. So, the higher conviction bets, typically you would see a larger allocation. But if you weight it based on risk, I think that's an intelligent way to think about it, because otherwise you could end up with something pretty crazy, right? You could say, well, my highest conviction idea is also my highest volatility by a factor of 3. Well, suddenly your portfolio could swing around, 15, 20% because of that one constituent in the portfolio. All right. So, Ranjana Gupta, we're going to go to your question now. Hi, Mike. I understand how delta and theta can be used to make option trading decisions, but not gamma. Here is what I know. Please correct me if I'm wrong. So, for those who don't know what delta and theta are, delta is just the rate of change in the value of an option with respect to changes in the price of the underlying asset. This is usually presented as when you hear options traders talk about it, they will say 30 delta as a whole number, but generally this is going to be, if you're looking at an actual option, it's on a per share basis. If it says 0.3, then that means that the dollar value of that option is going to change at 0.3 times the dollar value of the underlying asset. Actually, since we have something up on the screen, why not show it? So I happen to have Coca-Cola up, so why don't we just find an example. And I'm going to go out, because I want to pick, there's actually a gamma question in here too, but I'll just go out to October, regular way. And I will pick the 68 calls right here. Okay? So these, hopefully you can see this, it's highlighted. I don't know if you can see my cursor because of the way we do the screen share now. So if this is a 32 delta option, that's how we would commonly say it. It's 0.32 though. If you're looking over on my screen, you see the column that's labeled DM. That's actually delta mid. So it's an interpolated value. It takes the midpoint of the bid-ask spread, which is actually pretty tight. It's only 56 by 59 here. And says it's 0.32. So what that means is that if Coca-Cola goes up by $1, we would expect the value of this option to rise by 32 cents. Now, each option's contract represents 100 shares, so it's actually going to go up by $32. And when you hear traders say, oh, it's 30 delta, what they really mean is it's 0.3 times whatever the multiplier. 50, 0.5 times the price times whatever the multiplier is, and so on. But that's what delta is. Theta is the amount that the option will decay, and it's usually expressed daily, right? So that's going to tell you how much the option decays each day. Gamma is the second derivative with respect to price. So gamma tells us how much the delta changes for moves in the underlying asset, which is what Ranjana has up here. So it is the rate of change of delta with respect to the underlying stock price. That is correct. The gamma of deep in the money or out of the money options is close to 0. That is also correct. The gamma of at the money options is close to plus or minus 1. The gamma of at the money options is close to plus or minus 1. Okay. It is true that the gamma of an option is higher if it is at the money, but it is also true that the gamma of an option is higher if that option is close to expiration. So if you go further out in time, those options are going to have considerably less gamma, even if they're right at the money, than nearer dated options will. So it is a function of both things. The other thing I would say is that the gamma of a long option, whether it is a call or a put, is always a positive number. Right? So an option that you own is always long gamma. And an option that you are short, or it's 0. Okay, so it can have no gamma or it's positive gamma if you own it. If you are short it, it is always going to have 0 gamma or it's going to have negative gamma, regardless of whether it is a call or a put. So think about this for a second. This is kind of important. No, it's not kind of important. It's really important. So it's very important. And in fact, options traders, when we look at let's say we look at our positions, we tend not to say, oh, I have this many calls and I have this many puts on all of these different strikes. Because when I was a market maker, I could have hundreds, maybe thousands of options positions. I was really just interested in whether I was net long or short a strike, right? So if I am long a put and the price of the stock declines, I am getting shorter deltas as the stock goes down. And I am getting longer deltas as the stock goes up if I am long a put. Now, if I am long a call, that's also true. I am getting shorter deltas as the stock goes down, and I am getting longer deltas as the stock goes up. Now, if this doesn't seem intuitive, maybe we can think about it this way. We'll just continue to look at Coke since we're on it already. And let me just see where put the quote for the stock back up, and then we'll bring this back. So, oops, that's a little bit sluggish. And I don't want to really use super short dated options because, you know, gamma becomes kind of theoretically infinite at expiration. Okay, so stock's about 66.5 bucks. So let's just look at the 66 strike. All right. Now imagine you're long the 66 call. And this thing right now is a 59 delta. What is going to happen if the stock goes to 100? That will be now a deep in the money call. It'll be 100 delta. So I was long gamma. I was long the call. My deltas went higher as the stock rose. Okay. Now let's imagine instead I owned the 66 put. If I just bought that put, I'm short 41 deltas. If the stock goes up to 100, it's further and further out of the money. The deltas have gone down. So it was short 41 deltas originally. Now it's short 0. I got longer, just like I did with the call, right? So long options have either 0 gamma or they are long gamma. And even though in theory, if you look at charts, you're going to see this thing where gamma becomes infinite, even where that's kind of theoretically true, the truth is that an option is going to have a delta of somewhere between -1 and +1, or minus 100 for a stock option for a put, and plus 100 for a long call. Those are the maximums. So even though gamma can in theory be infinite, you'll hear it described that way, at expiration, at the spot price, at the strike price, the truth is that the most that your delta can change is from an option's minimum to its maximum value, which is 0 to -1 for a put and 0 to +1 for a call option. Okay. All right, so hopefully we have that concept. If that seems, if anybody is missing that, share it in the chat here, and I'll just have somebody alert me to that fact. Okay. So how do you use this for constructing a strategy? Well, let's think about this for a second. You need to have a couple different views at once when you start thinking about gamma. So you're looking at the second derivative, and you're going to say to yourself, well, do I care or not care about being long gamma? Now I'm going to say, do you care or not care about being long gamma and not short? Why? Because there's never a benefit to being short gamma. There's no way to really profit from being short gamma. The reason that you profit on a short option is because of theta. The gamma is, whatever gamma you experience, getting longer if you're short, getting longer as the stock declines, or getting shorter as the stock rallies, that's the price you're paying to collect theta. So a lot of people will do things like look at the theta to gamma ratio. Do I really think that's a good way to think about it, and is that how I would trade it? Not necessarily. So the real question is, how much are you willing to pay to be long gamma, and how are you willing to pay for it? Let's see if we can find an asset that has an interesting dynamic. Well, actually, what difference does it make? We'll just use SPY. Okay. So if I look at the term structure of SPY, and I think that this is too steep. Okay? So let's just say, for the sake of argument, I think September 2026 implied volatility is too high. I don't think it should be 17.4. We'll start with this sort of operating premise. And I say, okay, well, I want to be short that because I actually believe that realized volatility over the course of the next year or so is going to be lower than that. So I want to be short those options to begin with. Let's further say, though, that I'm not willing to take unlimited risk to make that bet. And more to the point, I also think that, we're in this sort of rocky situation right now, that we could potentially have some kind of volatile event between now and the end of 2025. So I'm willing to be short 2026 options. I want to be short Vega, but I'm concerned about a near-term swing. How can I structure this to take advantage of that dynamic? Well, what do I know? I know that I have more Vega in the long-dated option. So I want to be short Vega, I can sell those. Now, if I buy a nearer-dated option, that Vega issue is not really going to play into it. Because I'm concerned about a near-term move, I say, okay, well, I want to own some gamma in the front. So what I can do, let me see if I can pull up my options play. Where is it? Here it is. Okay, so let's just work through an example like this. So what am I going to do in this relatively crude example? Now, this is going to be the simple version. There's a lot more that goes into this. I hate to say that everything becomes a little bit of a rabbit hole in the options world when you start looking at it, because how do you select your strikes? There's path dependency to some of these sensitivities, things like that. But we're going to just try to keep it pretty basic for now. All right, so I was looking to September 2026. Remember what I said before? It does not matter whether it is a call or a put. It is always going to be, if you own it, it's always 0 to long gamma, and if you're shorted, it's always 0 to negative gamma. That's it. So what I do next, if I have no directional bias, it does not really matter whether I choose a call or a put. I will choose a call or a put based on other factors. Like, for example, do I think that sometime between now and the expiration of the longer dated option that either something impacting the carry costs, like rates or dividends, could change? Then that will matter. Okay, so for now we're going to ignore that, and we're just going to say, okay, I want to choose a 50 delta long call option that expires in September of 2026, 1 year away. But I also want some gamma, and I'm going to be short that, right? Because that was the theory we were just operating under. And I don't want to have any delta risk, so I am going to buy a nearer dated option also of 50 delta. And so that'll be maybe the 666s here. All right. And now this is the strategy I have. It looks like this. Does that look familiar to anybody? It should. It probably looks a lot like a long straddle, right? So I don't have any deltas. I have long gamma. I get longer as the underlying asset rises. I get shorter as the underlying asset falls. And that is how I intend to profit on this trade. So the way you use gamma is when you are looking at the universe and you're trying to say, okay, let me think about the following. Let's assume you have no directional view on the underlying asset. Do I think long-term vol is high or low? Right? And do I think near-term options prices are high or low? If I think that near-term options prices are relatively low, all things considered, and we just saw, I mean, what was the implied volatility of the option I just selected? Let's see. They were the triple sixes, so we'll just look that up real quick. This used to work. I don't know if it's going to work now. You could just shortcut it. It did. Great. Okay. So the implied volatility is 14.25. That's the midpoint implied volatility for the November 666 call options. So I'm getting long gamma in this trade, short vega. Generally, if you are long gamma, you are going to be paying decay on balance. So that's, and then the question is, okay, how much is that worth to me? So really, when you're thinking about this, is volatility high or low? The relationship of how much you are getting paid is going to play into this. And then if you are interested in gamma, you can get long or short gamma and still kind of partially hedge by spreading it out over the calendar, as an example. Another thing you can potentially do is, trade verticals. So one of the reasons you might see some skew in some names, part of that might be operating leverage, balance sheet leverage. That is to say, if you have a company that's 50% debt to equity, the 25% out of the money puts should trade at a considerably higher volatility relative to the 25% out of the money calls. Why? Because the volatility of the equity is more levered to the downside than the upside. Maybe you think it's news related, right? So anyway, I would put that into your calculus. So hopefully that helps you there. So, and I think this question is coming from PC, because I see this question is from a prior video, and then I saw the same question showing up here in the chat as well. So the question was, when evaluating ETFs that harvest implied volatility through options overlays, I usually look at two dimensions: the price trend of the underlying basket, up, sideways, or down, and the level of implied volatility, high or low. Beyond those two, what other factors should investors weigh when deciding among these income-focused options writing ETFs? For example, should we be paying more attention to things like options skew, turnover, NAV erosion, or distribution composition? So there's a lot of questions all in there at once. I like to pay attention to, well, let's back away from the options rating ETF question. For those who don't know, I am associated with an options rating ETF outfit called Yieldmax. I think it's over my left shoulder right here. We run about $19 billion in options-based ETFs, actively managed. Some of those are single stocks. So, a couple of things. If it is a fund, it's going to be a little bit difficult because you're going to have to anticipate what the fund manager is going to be looking at next. Let me give you an example. Right? So, we have ULTY. It's one of the funds that we manage. Has, I think, $1.5 billion in it or so. And you can see, by the way, almost every ETF is fully transparent that's available. And what that means is you can go to the manager's website, and the positions will typically be updated overnight, so you can see what they've got in it, right? So if you're looking at this one, which happens to be one of ours, I have little incentive to really delve into somebody else's. You can see what we hold, right? So you can see the stocks that we have. We've got 1.2 million shares of Palantir. We've got 3.7 million shares of Rocket Lab. We've got 1.5 million shares of Robinhood, and so on and so forth. So the first thing that you probably want to think about if you're looking at a more diversified fund like this one is how do I feel about the stocks that they're in, right? Now, for funds like this that are seeking to sell options premium, harvest some options premium, chances are you're going to see these kinds of names. You'll notice, by the way, NewScale is in here, SMR, which we talked about, I think it was on Monday, when somebody was asking, hey, for my own portfolio, do you like Fluor, which owns a big chunk of NewScale, or NewScale? Why is NewScale in here and not Fluor? It has to do with the volatility. ULTY is looking for high volatility assets, names that have high options premiums, because they're looking to sell options. So that's a little different than saying, and also these are collared positions. So that meaning that the downside risk is mitigated because we own puts on these. You can actually scroll down here. Well, you probably don't have a Bloomberg, but you can go to the website and scroll down. And you'll see that we own puts on these stocks. We're short calls on these stocks, and we hold the underlying stocks. And we try to construct that in a manner that has that collects some premium. But the point I would make is that step one is, do you like what the active portfolio manager has selected for that portfolio? Because we also have a bearish one of these as well. It's much smaller. It's called Salty, and that's going to have a different basket of stocks in it. And of course it should, because presumably we're long stocks that we think are going to hold up or go higher, and we will be short stocks that we think are not. So if you look in here, you're going to see different stocks than you did in the other one. So that's the first thing. How do I feel about the securities that the manager has selected, long or short? Am I in alignment with that? So I think that's an important thing to think about. Now, that's not going to apply if you're looking at things like single stock covered call ETFs, because the manager's not making that determination on the stock. You, the investor, are. So if you traded something like Misty, which is a strategy covered call, that's because you like strategy. If you traded something like Coney, it's because you like Coinbase and you're trying to sell covered calls on it and you want somebody else to manage that for you. So I think those things are important. Let's talk a little bit about turnover. So not all of these products make distributions with the same degree of regularity. And the regularity with which they make distributions is going to impact the strategies they can employ. So JP Morgan has a strategy, JEPI. I don't remember what this ticker is. Is it JEPI? Yeah. So JEPI. I mean, this is one of the biggest ones anyway. What's this one got in it? Yeah. So this has got 40 billion bucks in it. So obviously pretty chunky. You can see the underpinning stocks. Now you're going to look at a fund like this, and then you can go and take a look at the options strategy that they have going on. Now in this case, they're trading sort of index options against it, and then you can take a look at the total returns, and you're going to notice that the characteristics of this is going to be quite different than the characteristics of, because they're trading options that go much further out in time. In general, the equity portfolio is lower volatility, and so it's going to have very different risk-reward characteristics. So this is JEPI, which is JP Morgan's $40 billion fund. It had 4.32% total returns had you reinvested in the fund. If you had just owned the fund and taken the dividends out over the course of the last year, we can assume that you would have collected about 8% in dividends. Not bad, right, over the course of the last year. How am I getting to the 8%? Well, we know that the price is down 4, and if you had just put the dividends into cash, you're up 4 and change. So we know that it has distributed at least 8% in dividends over the course of the last year. And we can see that in the dividend schedule, and you can see here that they distribute dividends once a month. Okay? Well, if you care about getting more frequent distributions, ULTY is the one that we manage, which is considerably smaller than JP Morgan's. This thing is making distributions every single week, right? It's also going to be much more volatile than JP Morgan's. It also has very different returns, right? So the total returns for ULTY over the same period, over the course of the last year, as of right now, up 28.5% if you reinvested the dividends in the security. So if you reinvest in the fund, your total returns would be about 18% if you had just taken the distributions and put them into cash or into your checking account or whatever and earned, in this assumption, 3.96% interest. And your total return, the share price, has actually gone down by 46.5%. And that's because the distributions are the difference. So it's going to be, we'll call it 18% plus 46% in round numbers. So 66, it's distributed, call it 66% of whatever the share price was as of a year ago. Total returns 28.5%. So when you're selecting between these things, you're going to have to decide for yourself, okay, do I like what's in it? Do I like the fact that they're selling longer-term options, which can sometimes also have benefits? Or do I like the fact that they're selling short-term options, which has its own set of benefits? And, how do I weigh those things? What are those benefits? Well, the benefit, I actually think I showed this chart before. I'm going to pull this up. The benefit of trading a long-term option is that it mutes that volatility. Why? Because the gamma doesn't change. We were talking about this, right? So if the gamma doesn't change for a long-dated option, if the gamma is very low, for a long-dated option, that means the delta doesn't change. So if I'm long a stock and I sell a 40 delta option, that means that my portfolio is going to have relatively low volatility relative to the underlying asset for a prolonged period of time. A short-dated option, which has a lot of gamma, that's not going to be true at all. So it's going to be much choppier. But the advantage is that near-dated options decay much more rapidly as a function of their own value. And so that's, this is this balloon that I sometimes refer to people squeezing, that you're trying to trade off volatility, choppiness, things like that short gamma effect, which is kind of why I wanted to take these questions in this order, versus smoothing those things out, but getting a lower rate of decay, which is, if you're an option seller, the thing you're trying to harvest. So, PC, I hope that helps answer the question a little bit. Okay. So let's now move on, and if it didn't, maybe we can come back to it, but I want to get to some of these other questions. Finwest says, good morning, Mike. How are you feeling about Costco earnings tomorrow? I'll be selling some puts, just not certain of the exact strike right now, but probably the November. So Costco, we're looking at probably mid to high single-digit same-store sales growth for the upcoming quarter. One of the advantages that Costco has over some other retailers, because we've had a lot of uncertainty with respect to things like tariffs, is that they don't have an enormous number of SKUs, and that floats. SKUs, I'm just talking about the products that they sell, right? So Costco, some things they sell is, it's going to be fairly consistent. You can go to the meat section, and the meat selection doesn't really change that meaningfully from one week to the next. But almost everything else does. How many times have you gone into a Costco and looked and saw something that interested you that was not a food product, which those things are fairly consistent, and then later said, you know what, I kind of like that, and then you go back and they don't have it anymore. One of the reasons you kind of get people picking around the place all the time is that, what they're selling, other than the stuff in the pharmaceutical section and the stuff in the food section and the stuff in that very first area where you have the electronics, right? So you go in and there's always some Apple phones and computers and TVs and stuff like that. But all that other stuff in the middle, a lot of that changes, and a lot of that stuff that changes are the kinds of things that are likely to be impacted by things like tariffs. And this is a good operating position for Costco to be in, because they can just sort of say, this is compelling, and it's compelling at this price, and so we're going to offer it. This was compelling. It no longer is because of whatever factor that might be, and we're not going to offer it. So that's a happy place for Costco. That's the good news. What's the bad? Well, the bad, where Costco is concerned, is that a lot of that good news is really priced into this sucker. Right, so we can take a look right. Well, actually, I've seen it more expensive than this. So that's interesting. So we're looking, earnings are going to be for the last fiscal year, ended at the end of August. So when I'm looking at what you're buying now, if you own Costco, is you're buying future earnings, not what they did in the past. What they're going to do in the future, we'll just call it $20 in adjusted EPS. So it's trading 47.25 times forward with a year-on-year growth rate of about 10.5%. So I have seen it trade at higher multiples than this, but that's not hugely cheap for a 10% grower, which is why, by the way, that probably selling puts isn't a terrible way to play it. Let's take a look at the historical moves. We can see that downside moves are typically pretty muted. We've had a couple that were a little bit sharper to the downside. So the worst moves we've seen within the last 8 reported quarters, day following, was the Q2 25 report that they released on March 6th. Stock fell 6%. And then, as we can see here, is the Q2 24, so 1 year earlier, declined to 7.64% in a single day. Probably a better way to think about this is, why don't we just take a quick peek at what it does by, the end of that week, give or take, right? So we'll just go from, today's the 24th, we'll go from -1 to +1 and see what that looks like, see if these moves are any more pronounced. This is probably more representative. Worst downside moves in this case was Q2 earlier this year, down 8%. So we'll just take a peek. Oop. I thought I selected options play, but I don't see it. It's not coming to the front. What if I do this? There it is. So 8% to the downside. Oh, one more thing before I get back to this. Okay, so 8% to the downside, that's the worst, basically week of. But then let's also take a quick peek at, 1 month after. What's the worst case? And here, this is, I think, also representative, because if you're going to try to, say, sell a 6-7 week option, trying to take advantage of vol crush and things like that, which I think would arguably make some sense, this gives you a sense of what the worst case is. So here, that worst case that we had, 10% is as bad as we've seen in 11 years, 44 reported quarters. That's the absolute worst 1 month down the road post-earnings result that we've seen in Costco. So when you think about the puts that you're going to sell, it's probably good to say, okay, well, I'm going to take that spread and say, okay, here's the worst thing that can happen to me, and I'll work from there. Okay? So you're thinking about selling puts. This thing's got buying them, because I guess the short-term indicators by options plays work are bearish here. But let's just take a look at this thing. That's 58 days. I would probably look at it more like this. Stock's 950. 10%, $95. So 850s, as that would be the worst it could be, at least using the last couple of years as a guide. I want to get at least 1% per month. This is about 2 months, so I'm looking for at least 2% of the current stock price in round numbers. So I want to get at least $19 out of this thing. So that's going to be like these 9/10s right here. Okay? So a trade like that would probably fit the bill for me. Now, 800. You were down at 800. Oh yeah, look at that. All right, well, let's take, so there are people, and look, I respect people's thinking on this. There are folks who are out there just looking to say, okay, I want to sell an option that I know I'm not going to get assigned on. Full stop. that is fine. And in a name like Costco, that's probably more fine. In a name like McDonald's, that is more fine than it is to do it in a name like Intel, where we've got news coming out and it's clear that there's some financial distress going on. I think the likelihood that anything ever came out about Costco that was, world commie in nature is very, very low, right? But in general, I'm not one of those people that's really crazy about selling options unless I'm getting an equity-like return relative to my risk assessment. But let's just take a look. Since you chose the 800s anyway, I don't know what expiration are you looking at? November. Okay, so you're in November also. So let's take a look at what those are. So the November 800 puts, where are those suckers? $3. Okay. That's $3 over the risk of purchasing the stock at $800. That's a long way down. Almost no chance the stock gets down there. But almost no is different than no. Than no risk. And $3 over $800 is over the course of 2 months. So if $800 is kind of my risk, that's 38 basis points. And it's really not, 38 basis points. Yeah, I think it's a very high likelihood that you get away with those. Let's see what options plays calculation is, in fact. It says that you have a 96% chance that you will not be assigned on those options. So very, very good chance that you sell that put and take the money and run. But I'll admit that that's not typically the kind of trade that I engage in myself. Yeah, so that's fine. But actually what I was going to do, and this is an exercise that all of you can do, is that I'm just going to export this to Excel, and we're going to go through a little bit of an exercise here. Oh, okay. Well, we got a lot of other questions. Hopefully I kind of got you, some of the stuff there. Let me punch through some of these others as well. Jim Howard, hi Mike, saw a recommendation for CARETRUST, CTRE, good fundamentals and technicals as possible vehicle to absorb money market funds, searching for yield. Yield is 3.86%. Maybe a buy right play. So, yeah, a quick point about that, and you're going to probably observe this, is that a lot of these types of funds, there's nothing wrong with that idea necessarily. A lot of these funds, you're going to see that, maybe the options volume, if there is any, is not that great. The number of strikes that they have is not that great. And the spreads on these things are not that great. Volume begets volume, and so it is true here, right? So what buy right would you potentially do on CTRE? This is not a knock on CTRE. This is just a knock on doing a buy right in CTRE, and that is that you can see that probably the best candidate would be the no 35s, and those things are 65 cents by 290. You might be able to get something off in the middle. We see actually that a 2-lot traded today. What price did it trade? $1.10. Okay, not terrible. Not terrible. So if we can actually do a quick theoretical on that and say, okay, well, how is that a good value to sell that? $1.10? Oh, look at that. Oh no, that was January. Okay, so here we are. So $1.10, and I don't know what price it was. I should have looked. So that's 26 vol. That works out to 26 vol for that option. Is 26 vol a good implied volatility to sell? Well, let's take a look at realized volatility and see how that looks. So I'm just going to put 60 days in here because that's about how long it is. And so you are selling that option. If you can sell that for $1.10, you're selling 26 vol. You're selling it here. So if you're ready to buy the underlying asset and sit on that call until expiration, because I just showed that the bid-ask is kind of wide, and you can get that thing off at 26 vol or higher, I'll go along with that. I think that's pretty good, actually. At least based on how volatile it has been. Bear in mind that the higher the dividend an underlying asset pays, the lower the value of the call, and the higher the value of the put, all else equal because of the carry cost. Okay? But, yeah, so that's fine. But, you know, this is not something that'll be easy to trade into and out of, right? Because you could sell that thing for $1.10, and then you change your mind tomorrow and you decide, oh, I want to buy it back, and you might not find an offer at $1.40 for all I know. Okay. Ranjana Gupta says, yesterday I sold an OCT 2478 cash covered put on Zoom for 89 cents. Please give me your thoughts on the company and my trade. So this is an interesting thing. I haven't looked at Zoom yet, but one of the interesting things about Zoom is that it has a really big net cash balance the last time I looked, and let's see what it is now, and it is still true. So you can see the difference between the market capitalization and the enterprise value. That's because the company has almost $8 billion in net cash. What that tells us, and they're generating significant free cash as well. So what that tells us is that the skew in this thing should probably not be overly pronounced, because there shouldn't be that much downside volatility to equity, because that equity is increasingly becoming cash to the downside. So let's take a peek. You were choosing OCT, so I'm going to look at OCT. In fact, I'll even choose the expiration you had. I'm going to get rid of this so we're not looking at the noise. Ah, there's more skew in this than it probably should have. So selling puts in this actually looks a little bit more reasonable to me. It's not super high, but let's also take a look at the volatility. So we are getting some event-related vol. You can see these periodic spikes. That's usually going to be related to quarterly stuff. Yeah. Good. I'm good on that. Well, by the way, this speaks directly to some of the things we've already been talking about. How much volatility is the equity going to experience if the stock goes down towards the strikes that you are short, or long if you're buying them? If a company has a net holder of cash or a net holder of a lot of cash, let's go back to this. You know, you'd say, well, is that a lot of cash or isn't it? It's a relative thing. Okay, so the value of the business is $25.6 billion, and of that, nearly 8 is cash. Right? So I'll just round it up and call it 8 over 26. So the company's more than 30% cash and generating another 10% of the company's enterprise value in cash by each year. So it's a pretty good free cash flow yield. Why is it so cheap? Well, because the top line upside growth is kind of abysmal. But that's one of the reasons why selling puts might be an attractive way to go. So, and you're also getting more than 1% per month, so that works out to an attractive rate. Next question. Boo to you. Hello, Mike. If the market takes a downturn, what are the best Yieldmax funds to consider? Let's stick with the compliance rules first. I cannot make recommendations about the Yieldmax funds specifically. I cannot do that because I work for the company, and ETFs are securities, right? So if I'm out there trying to say, oh, you should buy this, that's the same as selling it. Selling it, if I'm soliciting people to buy a security, that falls into a certain regulated bucket of activities. I can give you some high-level guidance, though. A high-level guidance is if you want to know what's going to do better in a downturn, it's going to be the bearish strategies. I guess that should be obvious, but so if you think that Tesla is going to fall, crash is a better strategy than Tesla. If you think that a strategy is going to fall, then winter is a better strategy than Misty, right? So those are the bearish ones. And in general, Salty would be better than Ulty, because all of those have a bearish tilt. But whether it's our funds or anybody else's, that's the thing I would think about. If you are looking at somebody's suite of products and they do not have, the constituents obviously are going to be important to this. Diversified funds are probably going to, especially if they're diversified in different areas, are going to be more resilient than ones that have high degrees of concentration. And even ULTY has high beta stocks, but they aren't necessarily all the same play. Although, SMR, which is NewScale, which is, people think about it as a play on data centers because they're imagining that small new, modular reactors are going to be a part of that. It is kind of part of the AI play, right? So all of those things kind of feed together. I would just say you want to look for funds in general, whoever's funds you're looking at, that look like they don't have excess concentration to a specific narrative, thesis, that whatever we're thinking is a secular tailwind for that basket of stocks isn't going to suddenly turn into a headwind. So I'll leave it with that, and wish I could offer more specificity, but it's probably best for me to avoid that. PC's questions, which I'm going to skip because we addressed these already. Okay, DJ, let's talk pharma. What's your take on Pfizer and Bristol at these depressed levels? Pfizer depresses me full stop. And it's not because it's not like this thing is hugely overvalued by some metrics, but those who have listened to me for a while would know that this just doesn't show up on my radar. And here's the reason. I don't know, is this highlighting? Someone can tell me whether, if I move this up and down, whether at least the highlight shows here. Okay, so right here, I'm highlighting right now, the cell that I'm highlighting is the full year 2026 adjusted revenue expectations from, it's an average of what the sell side expects, $62.8 billion. Let's just keep the numbers round. Well, the trailing 12 months is 63.8, not dissimilar to last full fiscal year's 63.6. So that means that the revenues are going down on the top line. And, that's the estimate in dollars when the value of a dollar also goes down each year as well. So it's a shrinking company. And you could say, well, it's trading at a very cheap multiple. Okay, I'll go along with that. It's expected to earn more than $3 in adjusted EPS. It's trading at $24 a share. Decent free cash flow. A lot of debt. It's just not. It just doesn't interest me or excite me. These things are. They're maybe a value. Maybe they're a value trap. I don't know. I look for things that I can say definitively, this is a business that's in the right business. And I don't feel that way necessarily for Pfizer. In Bristol's case, we'll take a look at this one too. I don't know that the circumstance is really that much different. It's kind of the same story. So again, I'm just not terribly jazzed. And this is a separate issue, which is that the real reason to buy Pfizer recently, and when I say recently, I'm just talking about within the past decade, was surely the vaccine business. Well, I think the bloom is off that rose pretty definitively. So if you're interested in pharma, you're interested in pharma that is in the big story for pharma and growth right now. And what is that? It's obesity drugs. Ozempic, Wegovy, GLP-1s, Lilly, Novo, that's kind of the place. Now, whether you like those valuations or not, if you don't like the valuations, don't buy them. I just, whenever I'm looking at companies, I would like to look at them and say, if I had to, someone puts a gun to my head and says, all right, you can stick this in your portfolio right now, but you can't sell it for 20 years. What's my hope for these? I wish I could be more helpful. Both of these companies, like I say, carry a lot of net debt. It's not like they don't have the free cash flow at the moment to support it, but I can't get excited about these. I just don't. I am more interested in looking. The S&P 500 is a good diversified basket of stocks if you don't know what else to do. If you want to pick stocks to add to that, to be an active manager of your own future, look for the things that are likely to outperform it, not the ones that are just cheap. Who was it that said it? Again, I think it was Charlie Munger and Warren Buffett maybe said this, and I kind of agree with them. I think Warren Buffett had what he called the cigar butt strategy, where he would look around for cigars that still had a few more puffs left in them, and Charlie Munger was the one that just said, what are you doing? If you're going to invest in businesses, invest in good businesses. That's it. Doesn't mean I wouldn't just... Maybe I'd take a punter on one of these things if I thought there was a catalyst that could help it come to life, but I don't know what that is right now. So, again. So, PC says, I switch between ULTY and YMAX. Those are both diversified funds. So, yeah. Anyway. Thoughts on Viking Holdings? November 21st, post-quarterly earnings result, out of the money, 65 long calls. Down 20%, buy more, hold or sell, thanks in advance. Okay, so Viking, as far as I know, it's not a name I've been looking at, and I don't think we hold it, do we? I'm going to double check. We might know something. Not really. 1,269 shares in some fund somewhere, which is not a lot, as you saw, because with funds this size, that would not be hugely meaningful. But let's just take a look. So let's look at the fundamentals. Before I'm even going to look at a price chart, let's just look at the fundamentals. Okay. Good top line growth. Reasonable multiple. Respectable free cash flow and respectable free cash flow growth. So far, so good. So just looking at the fundamentals, we kind of like what we have. Now, let's just take a look at I'll look at the chart. I was going to see, do I want to look at the technical models or the chart first? We're going to look at the chart first. So far, so good. That's not the end of the world. I'm going to get rid of that. I'm just going to put in a single, just an automated trend line. So I'm going to put in not all of those moving averages, which is a little bit noisy. Just going to put in one. Looks like we're solidly still above that trend line. That's fine. And now let's take a look at what the best performing technical indicators in this thing have got to say. And which ones were you? Novi, okay. It looks like the best performing technical indicators are also still bullish. What's coming up catalyst wise? So there is this. What's this? This is going to be happening on Friday. What is that? Industry expert meeting that's going to have Viking, Royal Caribbean, Norwegian, Disney, and Carnival all participating. That's the day after tomorrow. And as you point out, the options you hold are expected to expire after their quarterly earnings results. Just going to double check that. When's regular way November expiration? Same week. Okay, so they're expected to report on the 21st. Implied volatility is 38.8 for the options that you own. Not, well, they're not paying for themselves with gamma right now. But what we also know is that the implied volatility of those options is going to go up as earnings approach. So that's going to be a little bit supportive, or it should be. Well, it's actually not as pronounced as I might have thought it would be. So this is 1 year. How far back can we go? So what I'm looking for here is I'm looking for a pronounced spike in 1 month implied volatility before earnings catalysts show up. The idea on that is that you can estimate then what the implied volatility of that option will be 4 weeks before it expires. So if we think it's going to be 50, what that tells us is that we can then go and say, all right, well, what is that option going to be worth? What is an option on Viking going to be worth, assuming the stock stays right here, when it has 1 month to go? All right. So for that, I'm going to say $60 strike on Viking, call, 30 days to go, and I'm going to say an implied, where's the vol? Here we are, 50. So that's $3.70. Okay, so $3.70 a share. So I'm now thinking to myself, what do I think this call would be worth if the stock is right here when that option only has 30 days left to go, based on my assumption that implied volatility for that option is going to increase to capture the event variance associated with the upcoming earnings that's going to happen at the end of that month. Because really, by saying that I'm going to hold that option, or that I might add to it or buy it right here and right now, that's kind of the downside, right? So you're going to be supported by increases in implied volatility, and then you're going to be fighting decay. So how much decay? So we got 370 out of that thing, and now we have, that's not a lot of decay, because the thing's like 430 now, right? So over the course of the next month, so here's the other way to think about this, right? So we can actually look at this and say, all right, well, what is the implied decay in that option right now? So the decay right now, if volatility stayed here at 42, and I go to 30 days, so this thing is now worth $4.30 at this level. That's actually the upper end of the range. Now we're going to say, okay, well, that thing would now be worth, I have to take this volatility down. So I'm going to say, oops. On a standstill basis, the implied decay is actually going to take the value of the option down to 313, 314-ish per contract. I believe on a standstill basis that overstates it, because I believe implied volatility will rise. It will rise because you're going to have the event variance baked into the cake, and that'll probably take the implied volatility of this option up to 50. So on a standstill basis, really what you're dealing with is something in the neighborhood of, 60, 70 cents worth of decay. Now, the rest of this I'm going to leave up to you. I'm not making a recommendation about Viking one way or the other, but that doesn't seem all that bad to me. Bob, on Viking. That doesn't seem like a really bad decay. So, hope that helps. Let's see. Quickly here, Steve. Oh, Corey Henderson. Let's see. Oh, can you check ALAB for me? Crazy action today. Citi raised the price target to 275. I'm long through option spread. Okay. What's going on with ALAB? Whew. Did we get news on this thing? That's... Stereolabs, 13% emitted V-top. I'm not going to speak to the pattern. I mean, we all just looked at the chart. What else is going on here? Let's see, do they cover this thing? Let's take a look. Yeah, I mean, it's really, I guess it is just trading off of technicals. I mean, there's not any situation like this where it's all basically speculation. It's not that it's a pre-revenue company. It's not. But I mean, this thing is you know, very pricey stock. It is pricey stock because there's huge growth forecast and all the rest of it, and everybody likes that. But you know, this thing is trading 40 times revenues. Is that right? Maybe a little bit more full year. So full year estimated revenues. I'm just going to round up. Yeah. I mean, trading even more than that. I'm looking at the enterprise value, by the way. There's $1 billion in cash here. Yeah, I apologize. I don't think I have any really good insights for you. I mean, you're going to, a name that's, this is just going to be very high beta. What is the beta of this thing? Let's see. It doesn't even calculate it. Yeah. Sorry, I don't have more insights on that. Okay, let's take a look. Okay. Hi, Mike. 2 questions. PayPal, which has great numbers, forward PE of 11, but wide dead stock price? I think competition is part of the story. There's a lot going on in the payment space. I would say that, to me, PayPal still seems pretty reasonably valued. You know, full year, next year's full year revenue growth estimates are, you know, in the realm, right? So we're talking about 4, 5, 6% or above. EPS growth faster than what the S&P is forecasting. Solid free cash flow, and you know, looks like pretty good adjusted EPS numbers. So from my perspective, I think PayPal is still reasonable and cheap. So this would be an example. Remember before when I was talking about Pfizer, why really low PE, and I said, you know, I'm not that interested because the company was shrinking. This company is not shrinking. It is growing. It's not growing as fast as it once did, but it is still growing, at least on pace with the market, but it's trading at a much cheaper multiple. And, you know, it's in a business that, you know, is expanding. You know, the industry is not a shrinking one. They are facing more competition. That's the issue for PayPal. But it's not that the payment processing side of the business, as a business, is like the buggy whips. It absolutely isn't. So I think this one is still okay there. Now there's 2 pages here. Did I miss something? I got that. Sorry, as I scroll through here because I was talking about other things. Okay, let me see if I... Oh, okay, here we are. What percentage of options to portfolio of an account of registered and non-registered, or percentage for covers and spreads, earn some income, or just insurance? I need help. I'm making up for a generation. That's the follow-up question. So, yeah, I'm not 100% sure what you're asking me here. So you're asking about whether options what percentage of a portfolio might be used to generate income, and what percentage of a portfolio you might seek to insure. I would say that it is possible to do both. Actually, that other fund that I was talking about, ULTY, that's effectively what it does do is collared long stock positions. So you are long the underlying stocks, and oops, that worked out well. Long the underlying stocks, long puts on those. This is simplifying because actually there is more flexibility in the fund, but we're talking about option strategies that all of you might employ in whatever way you see fit. You can do both of these things. There is a cost when you do that. Whenever you sell an upside call, you are foregoing some of the potential upside gains that you otherwise would have made. Whenever you buy downside puts, whether you do it via put spreads or just via outright puts, you are going to spend money to do that. In general, for most single stocks and for most indices, if you sell upside calls and buy downside puts, and you do so in such a way that you're collecting options premium, your positive theta, chances are you have more downside risk than you have upside potential because of skew. So, that's sort of going to be partially something you're going to have to figure out on your own, and it's also going to depend a little bit on the names that you have in there. What would be a circumstance where you'd be more comfortable reducing the amount of premium that you collect, increasing the amount of protection that you have, if you happen to believe that securities prices are starting to get stretched and you're concerned about a potential pullback? I talked about this with Mark yesterday on Office Hours, which is posted on the channel too, if you want to watch that conversation. I wanted to add two things. Oh yeah, by the way, Office Hours are now going to be on Tuesdays, not on Fridays, just because we're trying to accommodate his schedule and mine, and he teaches classes, and he's not teaching classes on Tuesdays this semester at Rutgers. So we just identified that as a suitable time to do those. So he's going to be in his office at the university on those days, and we're going to try to get an hour-long video in. I wanted to mention two things that we didn't touch on. Tom Lee, who is a longtime bull, is still a bull. I think he's always a bull. And for the most part, he has therefore always been right. Because, since he's been in the business, all the risk assets have generally gone up, so he's been right. Let's give credit where it's due. He has pointed to the large balances that are in money market accounts as evidence that there is a lot of cash sitting on the sidelines and therefore available to be deployed to risk assets. I don't remember what the number was. Somebody mentioned it to me. But it's in excess of $7 trillion. And I will concede that based on what I know about the cash that is sitting on the sidelines, that it is typically in the hands of much more well-heeled investors than... so that's not equally distributed. If anything, there's a greater sort of bifurcation in cash balances than there was in the immediate coronavirus COVID transfer payment era, because I think lower end of the household spectrum that those households actually have, that all of their positive cash balances effective those transfer payments has been eradicated, and that they're actually more indebted now than they were even before all of that. I will say, though, that my expectation is that more sophisticated investors are probably waiting for a material pullback before they deploy those assets. So I don't necessarily believe that is going to propel a rash of buying between now and year's end. I believe that cash is waiting for an opportunity to deploy. I believe it will if you get a big sell-off, but I am not convinced that it's a huge tailwind for equities going into the end of the year. But again, Tom has been right for many years, and he's a thoughtful, intelligent guy. So I'm not trying to dismiss anything he has to say. That's just my take, because equities look rich. Yep, they look richly priced. Donovan Young points out 7.7 trillion. That sounds like the number that I read. So. That's the case from Tom. Who else has indicated that equities, have a potential tailwind or are not as high as they might otherwise have been? Someone very different than Tom Lee, controversial, outspoken, Peter Schiff, longtime gold bug. He has also been right. He is actually looking at this from a very different perspective. He takes a look at the value of all the S&P, all equities, publicly traded equities, and he divides by the price of gold. The logic there is that he's saying that if you look at the price of stocks in dollar terms, knowing that dollars are being utterly debased by, reckless monetary and fiscal policy, that you should be thinking about it in terms of, we'll call it real money. Real money being, in his example, he believes that gold is real money. Okay, I'll kind of go along with that. That's a way to look at things. I mean, I like to look at the price of assets over time in gold terms too. Is it the only way to think about it? Not the only way, but it is a way, and there's some validity to that. He made the point that he thinks that equities are in a bear market because if you look at them relative to gold, they've actually started to roll over. The flaw that I have with that assessment, I'm going to wrap this up very soon. Producer's getting my ear. Like, your time is up. They're going to cut me off. The problem that I have with that is that when you buy a stock, you are buying its earnings potential, its corporate earnings yield, and its growth, and its free cash flow. So it is fine to think about the value of a dollar and the value of gold and the value of a company, but you also have to think about how much that thing can earn for you, which is a function of its margins and its growth. So I think Peter Schiff's approach is an interesting one. Think about it. Look at it yourself. But it can't operate in a vacuum. That's the only thing I would say about that. And I haven't spoken to Peter, I think, in probably 10 years. We had lunch in Dallas, I think, at a conference 10 years ago, but I don't think I've spoken to him since. Again, don't have an issue with him. I think he moved to Puerto Rico. That is all I have for you guys today because they're going to cut me off. They've sent in the hook and said, you're done, because I have been ranting around for too long. But I hope you guys come back and join us next Monday for another open mic session for office hours on Tuesday. Like, subscribe. Keep the questions coming in the comment section because, as you saw today, we do get to them sometimes. Thanks for watching.